I built Pistachio as a way to make it super easy to get your money on chain, to grow your money on chain without needing to have volatility risk, without needing even to have gas, right? Like you don't need a lot of big thing about Ethereum is in order to send money, in order to deposit money, in order to do anything on chain, technically you need gas, and our whole app is gasless.
Hey everyone, welcome to the Smart Economy Podcast, where we ask your favorite builders the questions you wish you could ask yourself. This is a production of neonewstoday.com, and I'm your host, Dylan Grabowski. In this episode, we're joined by Brian Smocovich, the co-founder of PistachioFi's, a smart wallet designed to help users securely manage their assets and earn yield. In this conversation, we discussed Brian's TradFi background and how those principles helped shape the outlook for Pistachio, the L2 landscape and their evolving relationship with Ethereum, how Pistachio aims to fix the UI issues associated with blockchain, the vaults that Pistachio deploys for earning yield, Brian's risk frameworks, and so much more. Just a reminder, nothing said on this podcast is a solicitation to buy or sell any tokens, and that the guest or host might hold tokens discussed in any given episode. You can check out a full disclaimer at www.neonewstoday.com. And if you enjoyed this episode, please consider rating it and reviewing it on your favorite podcasting platform, and also sharing with friends and family. Every rate, review, like, and comment helps us reach more people and bring you more of your favorite guests. With all that said, I really enjoyed this conversation with Brian, and I hope you enjoy it too. What's up, everybody? Welcome to the Smart Economy Podcast. Today, I am super psyched to be joined by Brian Smocovich, the co-founder of PistachioFi's, a smart wallet that helps you securely manage your assets and earn yield. Brian, what is up, my good man?
Dylan, what's going on? Thank you so much for having me. It's a pleasure to see your face again after many, many days together in Buenos Aires.
What a dream that was. So yeah, we first met at ETH Mexico last month, and then we got to spend a lot of time in Buenos Aires. So I guess before we jump into everything, how was your past month? You were at ETH Mexico, then you were in Brazil, and then you were at DevConnect. So what has the tour of LATAM been like for you for the past month?
Busy. I haven't had time. I just wish there were more hours in the day in a way, and I wish I had a second brain. It's the I guess the hard part about having a small team is that you have to do, if you don't do it yourself, it doesn't get done. And so beyond that, we also had 2 weddings. So I had one wedding and then a wedding the week after that, and then ETH Mexico the weekend after that, and then ETH LATAM the weekend after that, and then Buenos Aires. And so it's just been on the move, constantly going. Haven't even been home for 2.5 weeks. And now coming back home, and now I have another wedding and then home for Christmas. And so I am so ready in 2026 to just lay low, to be heads down, to build, to focus. Even right now, I'm very focused. I think you've seen some of the previews, but I've been getting really knee deep into more design work and kind of uplifting. And I want to create a stronger level of consistency throughout the app for the UI and the UX. And so I want more time to do that, right? I want more time to just kind of sit there and do that and really work on the product and polish things. And so I'm dude, I'm burnt out from the conference circuit.
All right. Well, before we dig into Pistachio and the app, the direction it's going in, the whys and the hows for Pistachio, I just want to get a little sense of who you are and where you're coming from. So before you stumbled into the blockchain and crypto rabbit hole, you were in the TradFi space. So what's your post-college beginning of your career looking like? How did you stumble in TradFi? What were you doing before you entered into the blockchain space?
Yeah. So my first job out of college was like, it was like tough to get a job out of college. I couldn't find a lot of things. There weren't a lot available. And so I ended up finding a position back in Manhattan in New York. So I'm originally from Long Island and wanted to work. Like I was only really applying to jobs in New York City. And this was like 2013, and the job market was pretty competitive. I ended up finding a job as a financial advisor, like a retail financial advisor, essentially. That required me to get licensed, and so I received my like life and health license, my Series 7, my Series 63, and honestly, it was very brutal. It was a rude awakening into the work world. Basically, I worked 12-hour days. And I lived like an hour and a half away. So I needed to like train in, get up very, very early, right? So I mean, the hour and a half, that's like there and back, that's going to be 3 hours into the 12-hour day. So that's like 15 hours spent basically working, which was, so I think a lot of people think they work 12 hours a day when they don't actually work 12 hours a day, right? It's like, yeah, I do this. It's like, no, man. So basically it was 8 to 8. I had to be there at 8 a.m. until 8 p.m. And it was all commission. I didn't have a salary. And so the whole thing was cold calling. It was the majority of my thing. I had to do like 200, 250 calls a day, just picking up the phone and hammering the dial day in, day out, Monday through Friday, 12 hours a day of phone call, phone call, phone call, phone call, setting a lot of meetings. And like, I got pretty good at it. I was like, by the end of I only did a year there, but by the end of my tenure there, I was like a top 5 rookie. And so, which was great. Like I saw like a potential future there for me. And I loved the ability to help people to like have these one-on-one conversations, how to structure financial portfolios, how to mitigate your risk, what percentage kind of needs to be here, how you should be looking at life in terms of like short, mid, and long-term buckets. And what are some of like the cooler financial instruments that people can use or should be using to like structure their portfolio, right? And so it gave me like a very good basis, like fundamental, or just foundation for finance in general, and like wanting to have an interest in these things, because I generally found finance very interesting. But one, it was very tough, right? And part of it was like some of the people that worked there weren't very. I think they tried to like oversell certain products to improve their commission, which wasn't like very fiduciary of them. And like the people I worked with mostly were like had that fiduciary responsibility, right? They had that mentality. They wanted to help people. And so that's definitely what kept me in. Like my manager there was amazing. And that's he was like one of my favorite managers I've ever had. But I was just very deeply unhappy, right? Like depressed. And I was just like, man, I have to get out of this. And so what I thought at the time is, I'm like, I want to be a management consultant, right? I'm like 22 or 23 years old. Don't know too much, but I'm like, I want to help make a difference, which is so ironic in hindsight. And so in order to get in though, it was like really hard. Like a lot of management consulting companies only recruit from top level schools. And I went to a good school. Like I was graduated honors at the University of Delaware, which is I think recently ranked as a top, even like 25 or 50 like school in the nation. But most management consulting companies hire from like Ivy League, NYU, Columbia, sort of like top 12, 15 schools, right? And so like, how am I going to get into this? And what I decided to do is I found 10 different hiring managers like Bain, McKinsey, all these different companies in Manhattan, found their names. And what I did is I went down to the printer. I found the highest quality paper that I could find. I printed out my resume on these papers and I sealed them in a FedEx Express envelope. Because if you have a FedEx Express envelope and you send it to someone, it gets delivered to their desk, right? Like they receive this thing no matter what, because they get mail, they get this, okay? And so it's express. It's like high priority. And so I found the address of all their companies, and this is hard to do because we're not hard. It's easy to do, but it's not scalable, right? You can't send out like 100 of these very easily. So that's why I decided to just focus on 10. Sent them out to the hiring managers, and out of the 10 that I sent out, one called me back, right? One called me back and was like, hey, we'd love to interview you. And it was a small management consulting company called Kurt Solomon at the time. They ended up splitting up and getting sold off, half to Accenture, and the other half to a company merged and got called Wavestone. But so at the time, they gave me a ring and were like, hey, they mostly only hired from NYU, like almost exclusively from NYU. But the manager kind of liked my grit and he's like, yeah, sure, come on in. And the standard interview process there is like four interviews, right? It's like there's a cultural interview. There's a classic like case study interview. There's partner interviews. And so I had to go through 6 rounds of interviews because I was not from NYU. And the same thing, it was like, there was like 7, it was just one extra of each essentially of a case study, an extra personality, behavioral interview, cultural interview, and then the partner interview. And I made it, right? They made it, I got through. And it was amazing because this was like a decent salaried position in Manhattan. And got to, I bought 3 new custom suits and actually moved formally to Manhattan, so I didn't have to commute every day. And my life just got significantly better, significantly happier. And what was honestly the best part about that job, so we had a whole bunch of different clients, but the best part was my favorite clients ended up being BNP Paribas and Credit Agricole, more so BNP Paribas than Credit Agricole, to be honest, in terms of my personal favorite, right? But they're very large French investment banks. And we worked directly with the C-suite for both of them, right? So that's like COO, CIO, CTO. And mostly I was helping manage like multi-million-dollar PMOs, rolling up a lot of information, managing a lot of different people across different verticals, and like taking all that information and formalizing it and then rolling it up in a way that is simple, digestible, and pretty for the C-suite to be able to like to look at this and be like, oh, okay, this is great. I can like make decisions and take action off of these things. And so that was like my, foray into TradFi. And then eventually what happened was in 2016, originally, I had a friend that was like, take all of your money and buy Ethereum, right? And I was like, that's crazy. I'm not going to do that. I'm like, I have like a 401k. He's like, yeah, liquidate it, put it in. I'm like, this is the financial advisor risk mitigation voice going off in my head of like, that's a terrible idea. All right, don't do that. And so what I did is I just took some extra cash that I had lying around, and me and my brother, we threw it into Ethereum. And as it started to cook in like the early days, we were like, okay, this is kind of starting to get a little higher. The Ethereum Enterprise Alliance just announced this thing with JP Morgan, and like all these like institutional grade players are starting to get into this. Like, what is this technology, right? And so I started to like read voraciously about Bitcoin and Ethereum, understanding of just like the digitization of money. Like that's like what really brought me into it, is like, this is digitally native currency that can be automated to a degree that in a composable way that traditional finance can't do, just right, because of all like the different siloed systems. Like the most connecting system that existed is Swift, and that is very, very slow, very legacy, and not being upgraded in any way, right? And so I'm like, this is the future. This is the future. We should get all the banks onto this because it's the future, right? Like get all the banks onto this back in like 2017. And I told my partners about this at the company, and they were like, absolutely not. Like no one's going to buy this. Like they don't want new technology. They are not going to make anything cutting edge, right? And so I'm like, well, I need to work in this. Like I am obsessed, right? I became very obsessed. And so what I decided to do was it was at the time, there weren't a lot of companies hiring in Web3. It wasn't even called Web3 at that time. It was just, right, crypto. And so I'm like, how can I get a job? Maybe if I improve my knowledge base, someone will hire me. And so me being a non-developer decided to take a Solidity developers course. And because I knew what Solidity was, and I'm like, hey, maybe if I understand Solidity, I'll be able to get a job in like product or something, right? Because like I'm work currently as a project manager. Like product manager doesn't seem too far out of my realm of expertise. And I went to this company called Block Apps, and they were giving Solidity course it was like a several day course essentially with like CTO types. And none of them knew like anything about blockchain. They were just taking it to like kind of get their feet wet, to understand, to see if this is something they want to like improve on in the future. And the guy giving the course was like, hey, can anyone explain proof of work, right? And this is me fresh off all of my my binge reading. So I'm like, yeah, I got this. Let me explain proof of work. I explained, he's like, that was great, right? And then a little bit, like an hour later, they're going through like their architectural stack, and they wanted someone to just like repeat it, right? Like, can anyone explain like what our stack is and how it works? And I'm like, yeah, like me, like I mean, I think you know by now, I'm very eager. And so I raised my hand. I'm like, yeah, let me explain this as well. And after I got done explaining their software stack, the guy paused for a second and was like, by chance, are you looking for a job in sales? And I was like, well, as a matter of fact, I am. Okay. So we spoke afterwards, and he's like, yeah, come by to this meetup that we're having at this basement in Brooklyn. You can meet our head of sales there. And I went to go meet her. And like, funnily enough, like I'm talking to her, she's like wants to know more about me and like why I want to work in blockchain. And while talking to her, like Joe Lubin comes up and starts talking to the three of us. And this is, right, early days. And I'm like, in my mind, I'm like, I know who you are, right? Like, okay, it's because his son was actually the CEO of this company called Block Apps. They were the very first company to spin out of the consensus mesh, and what they did is they had a enterprise grade version of Ethereum that they built in Haskell that they were selling as like basically a way for businesses. It was a B2B product, right? For businesses to create their own internal Ethereum-based blockchains. And so they needed someone who could be in sales that could competently be able to explain, technical things, like to speak the dev, but in a sales manner, right, in a sociable, outgoing manner. And so there was a good fit there. After a few interviews there, they ended up hiring me, and I worked for them for like 2.5 years in enterprise grade blockchain.
Wow. Quite a story. I think you went through like 5 of my questions that I wanted to ask you. So well done on your arc and being able to kind of like predict where we're going next. The enterprise kind of like chain, the Consortia chain was sort of the vision back then. If you have to like take a stab into the air and guess like why Consortia chains never really took off, and why today, like we see these TradFi guys building L2s, like what would you say it is? Why did the private or the public chain actually win? Why are L2s the kind of like thing that they want to build, and they're willing to settle and communicate through an L1 like Ethereum?
It's a good question. I think there's a variety of reasons. I think one, back in 2017, it was definitely first and foremost a timing issue. A lot of these companies didn't necessarily know what the technology was, and they were just doing their initial research. Like we spoke to probably most of the companies within the Fortune 500, right? That were like they all did their due diligence on blockchain back in 2017, and most decided to pass on it. I think one, it was too expensive back then to integrate a solution because it was so like early and novel. It was if you basically were building a custom database solution, especially internally, and so the price factor was high, right? Like you're taking a lot of risk in those early days. Two, it came down to this idea of it's like credible neutrality, right? Like a lot of things, or even before, maybe that's number 3. Like 2 is the speed. And so it's like, okay, if you're going to build this blockchain database, it needs to decentralize something, right? It needs to disseminate trust between multiple parties. It can't really just be for one company. It needs to be for some sort of consortium. And so, because a traditional database is just faster, just straight up, right? Like we all know that. It's like blockchains aren't like a better technology in terms of speed or throughput. They were meant to disseminate trust between different parties, and so that came down to like number 3 then. It's like, okay, you can't just necessarily get one player to do it unless it's like a very specific use case, and I can go into a use case in a second that does solve this. But basically it's like, okay, so if we want to share information, right? Because that's really like the use case of like the B2B areas. How are we sharing information? One, a lot of these companies don't want to share information between each other. It's like, okay, this is my competitive edge. Why would I share this? Okay, so we do have to share this specific sort of information. Can we share it in a way that makes sense in this trustless manner that the data needs to go on a blockchain to be automated from that, right? Like that's really the only use case if you can take automated action from that data. And so the actual like niche or the use case is kind of very specific. And one company that did use this, and this is all I believe public information now, so it's fine. But the biggest customer at the time was Monsanto that we had, right? And so a lot of what they were trying to do was basically like automation of supply chain management. And so, and this I always thought was like a pretty good use case for blockchain. I think it was just more of like either the technology that didn't work so well, like with DePIN now, I think it is probably even better. But it's like, okay, if we have these machines that are tracking the truck and when it comes in, and we can scan that, and then we can have like a verifiable ledger of when certain products are scanned in and handed off and by certain carriers, by certain delivery, like all the way from the farm, right? So it starts from the farm, and they can basically have like full data insight into their supply chain from seedling to sale. And because it's a very long process, right? And so for being able to collect like very granular data throughout that entire process would be a major boon for them. And they essentially built their entire own system to do this because they also don't want to share this data with anyone, right? It's why like a private database works for them. And then if you want to have a public, I think this is why like the public ledger essentially wins at the end of the day, is because if you want to be able to work together in this trustless manner, the information needs to be publicly available and verifiable by everyone and credibly neutral, right? And so, okay, if it's publicly available, now we can trust that you're not going to screw me over, right? Because who owns this private blockchain if we're going to do it? Okay, it's like if we're using public Ethereum, the public owns this, right? Like it's a publicly owned blockchain. We can build on this in a way that you don't own it, I don't own it, so we can. That credible neutrality is finally there, and I think that's why someone would build on a public blockchain as opposed to a private blockchain. Also, the liquidity, like all the liquidity is on public blockchain. Like these larger companies, like Robinhood, for example, who build their own L2. One, they built an L2 on Ethereum over Solana because they want to own the block space, right? With Solana, you can't own the block space as an L2. And so Robinhood, one, wanted that, and then they, two, wanted to tap into the existing liquidity of the EVM ecosystem, right? Because it becomes then much easier. Ramping is one of the hardest things in crypto in general. Like, how do you get someone on chain, and then which chain, and then is that liquidity easily portable to other chains? And it's a war at the end of the day, right? Like every chain is just trying to battle and retain TVL, which stands for total value locked, right? Which is liquidity. They're all battling for liquidity and trying to retain that liquidity on their chain because that's how they make more money and that's how they survive and they exist. If liquidity flees your chain, your chain ends up dying because you don't have any money, you don't have any transactions, people aren't using it, and then you become a ghost chain. And that's what happens we've seen with many L1s. And the EVM has a very sticky liquidity moat, especially because of the trust within the security of the L1, as to where people store the majority of their TVL, right? The highest TVL of any chain or of any ecosystem is the EVM by far. And so it's just, at that point, people want to tap into that. They want to tap into that already existing liquidity without needing to design and work with ramping providers.
Yeah, so this is kind of a little bit outside of the scope of Pistachio, but I did want to touch on this in general since you're building in EVM land. We saw kind of this vampire attack of L2s and the Rollup-Centric roadmap. We saw this negative correlation or externality that was associated with the launch of Optimism and the OP stack and these forthcoming ZK chains, and they were able to suck liquidity and suck value and suck activity away from the Ethereum L1 from 2022 basically through today. So how do we reconcile that? Because it was a little damaging to the Ethereum ecosystem to see all these L2s launch, their tokens launch. They took value away from the ETH token itself. If you look back at price action, it suffered a lot. So there was also still this kind of internal vampire attack. Is there, has that been fixed? Is the path forward going to be to unite this liquidity a little bit better? How do we reconcile the Rollup-Centric roadmap? And are things starting to look up for EVM landscape and Ethereum L1 and L2s?
I'm just smiling because this is such a good segue into Fusaka, which I know you've done your research on. I went and had to do an extra because I haven't had time to really look into the hard fork as much as I usually do, and so I went by and did additional due diligence into this, so that because I knew you were going to show me up on it, and I'm like, I need to do my own thorough due diligence, or as best as I can at least, because this is I think it's a forest for the trees situation. I think it was short-term pain for long-term gain, right? When it comes to yes, in a way it's like a vampire attack, but at the end of the day, all the settlement still goes to the L1, right? Not necessarily all the data availability, that is sort of split between Ethereum native and some other alternative providers. But at the end of the day, right, everything gets written back to the L1 security of Ethereum. And so it was also needed to scale, right? Ethereum was not scaling. It was having too much throughput, essentially too much demand in a way that the fee prices were spiking, and the chain became unusable for many people. The vast majority of people. And the idea was, okay, we could exist with this current premium, or realistically, if we want the world to run on Ethereum, we need to scale. We need to scale immediately. And that short-term solution was the L2. They are starting to scale the L1 right now as well. But realistically, they needed both. They wanted to go in the form of sharding, for example. And that was sort of not necessarily, it was scrapped, right? But portions of sharding were taken with 4844, with the way that they implemented blobs, and then especially now with Fusaka, they have data availability sampling. And so I think the plan was, and this is what from why I understand, because I was also very critical about this and why are we not driving more value back to the L1? Why are we just letting the L2s kind of freeload and take all this value? And the response that I got from the ecosystem was essentially for growth reasons, right? It's let these L2s become dependent on the L1, on their security, let them focus entirely on their app ecosystems, on improving their own throughput, on all these things, right? Well, without having to worry about security, because honestly, it is a major concern, right? You don't want to necessarily have to worry about security because now your whole ecosystem is at risk of being attacked. And so that's just another thing you have to worry about if you decide to build an L1 or pivot to an L1, when you can just eliminate that thought entirely by building as an L2. Which honestly is it's in my opinion the much better choice for chains to do rather than build an L1. Most people I think have built L1s over the last few years as just a way to raise money as a VC narrative. Really, then it's oh well, we can make things better, faster, stronger. It's why like they do it for the L1 premium when fundraising is like the blunt answer, right? And so I think it's much easier to do this L2 mechanism. And so we're at this point now with Fusaka coming. Fusaka is the name of the recent Ethereum upgrade that took place yesterday. And basically the whole intention of this upgrade was scaling, right? Scale the L1, scale the L2. And they did this in several different ways. Basically, this idea that to directly answer the question of essentially like L2s and freeloading and value, where the value gets driven, is currently part of the hard fork was designed to increase the minimum base fee of these blobs, right? And so that means that the data the data that these L2s write back to the L1 is not necessarily as cheap as it was. It's a bit more expensive. It's not necessarily going to be extremely expensive, especially as more blobs come into existence. Like I believe there's 6 right now, and in this upcoming week they're going to increase the target to 10, and I believe they're trying to increase this all the way up to 72. And so it's like there will be more blobs in existence as demand scales up, meaning these L2s shouldn't expect to pay an exorbitant amount, but all they did was design this system so that the blobs are just where the L2 store data, right? That's just they store it separately from the L1, and so these blobs itself, or they store it within the L1, but they it's just different. It's in a different place, and so. The cost of these blobs essentially would bottom out at times and be like very, 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 very cheap. And that's why no value is being derived to the L1. I think I saw something that if Fusaka had been live since blobs had gone live, the L1 would have generated like over like $70 to $80 million worth of revenue. And so at the end of the day, what this does, I don't think that they're going to capture that full revenue, right? Like some people are going to move their data to these alternative players because they're cheaper. Some of them are going to stay on Ethereum because it has better security. You're right. There is like a premium associated with the L1 blobs. But basically at the end of the day, what this means for both Ethereum and the L2s is that it should be a more symbiotic relationship as opposed to like a parasitical relationship from the L2 to the L1s. They inherit the L1 security. They're going to have to pay a little bit more. It shouldn't be exorbitant again. But basically, more value is going to be driven back to the L1. More ETH is going to be burned. More revenue is going to be created for stakers. And so overall, it's like it creates a healthier L1 ecosystem and a more valuable Ether.
Yeah, so from where I stand, this is kind of like the first of 3 things that seem important to me for allowing the EVM, like the L1 for Ethereum, and also the ETH asset to accrue the value that it's due. Fusaka is like a great first step, especially as we talk about creating a market for paying for these blobs. But also there's a future of like native rollups and leveraging Ethereum to be the DA layer for all these L2s. But then also something that came out of DevConnect, and we don't necessarily need to go into like super deep detail on these because I myself haven't done my deep due diligence yet. But we have native rollups coming in the future, as well as this interoperability layer for Ethereum. So as we kind of like move forward and we continue scaling the L1, what are just like some of your insights into how the native rollup landscape and also EIL will be able to further enshrine this ability for L2s to kind of like send value back to Ethereum as the L1 and the ETH asset?
I actually haven't done as much research into this
Okay.
niche, so I think I would be doing a disservice of trying to opine on it.
Dude, let me just like pivot then, since we don't want to like pull answers out of our asses then. And this is a great opportunity to kind of like finally start talking about Pistachio. So Pistachio is a smart wallet app, and when a user goes on there, they can send any of their assets on an EVM chain to the smart wallet, and the app will be able to like natively swap internally and also send assets into the token that is used into the vaults that are being used. So let's just do like a quick 30-second pitch of what Pistachio is And then secondarily, I would love to like keep building on the line of communication we were just having and talk about the role that L2s and L1 have in the way that you build out Pistachio.
Yeah, because that actually had a very large influence on how I did decide to build the app. But basically, Pistachio itself is so over the last 10 years, I've just heard complaints of the Ethereum of the Ethereum ecosystem, right? Mostly around like the UX, whether it's fees, whether it's token approvals, whether it's seed phrases. It's all of these things that kind of combine into one poor experience for normies, right? It's kind of the thing is, if you want to get into Ethereum, you have to like learn all of these things. There's a lot of education. There's a lot of within the rabbit hole, and just blockchains in general, right? And it's sort of even why Solana kind of had a very dominant period about like 2 years ago, was because they had focused on this user experience of trying to make things easier for the user. And so I wanted this for Ethereum. Right. I wanted something that was mobile first, because the world is mobile first, right? Like crypto in general is very desktop first, like for like Chrome extensions. And so I wanted something that was easy for the majority of people to be able to use, access. So you don't have to worry about seeds. You don't have to worry about gas. You have a wallet that we made it basically nearly impossible to be hacked. It's like to lose your money from an external threat. And also the ability to very easily cryptographically recover your account without us being a custodian and without us holding your keys for you at any time, right? And so we did all this, which is like really cool. I actually had a lot of compliments over the course of Buenos Aires when I had an opportunity to explain how we, do key distribution, key recovery, and everything, and which was really cool to see people like really like understand it and vibe with it as like, yes, this is a good way to reach retail, right? And so just making things like safer, easier for people, and then the idea of where Pistachio's like current iteration is and moving forward is, I want it to be basically your portal to easy, high quality, low risk DeFi, in a way where you can just like very easily earn and compound your money. A lot of crypto over the last cycle has been focused on like the casino games, right? And I think that's what gives crypto like a very bad name. Mostly because it's PvP. Like a lot of crypto games and meme coins, for example, are PvP games in which the winner is the one who has like the asymmetrical information, the one who has the information beforehand, usually the one who's launching the token. And whether they rug or they use bots or whatever it might be, they're extracting liquidity from the average Joe who comes in as hey, my friend made $10,000 off of meme coins, right? In which some people still may hit that, but you're probably better off just like playing the lottery than like trying at this point, right? Early in the early days, yes, you could actually hit meme coins with more consistency and more widespread, just with a higher rate before basically the information became too asymmetric. And now you can. Now it's very difficult. Like I would not really recommend most people try. And a lot of the apps that were being built in these days for retail were betting apps or gambling apps or meme coin apps. And I'm like, no, man, that's not. I think it's just, that's how you get people to really hate crypto, right? Because overall, a lot of people who came into crypto in the early days maybe bought at the top and with the volatility lost a lot of money and they never came back, right? Because it's like, man, I lost so much money, like I'm getting out of this. And the same thing with meme coins, right? Like they try to get in, they try to get rich quick. And the reality is, in order to make like a 10x, you have to take money out of someone else's pocket and put it into yours, right? That's kind of like how like big 10x hits. Like equities don't even do, within like rare exceptions, like that sort of like insane growth. And usually you're not even a part of that unless you're doing very deep due diligence, right? And so in my mind, especially with my like financial advisor, putting my financial advisor hat on, it's like wealth is long term. Wealth is built over the long term and built with risk mitigation and built with compounding interest, right? And so there's a lot of really good opportunities in DeFi to build with these sort of safer, low risk yield opportunities in which you can outperform US Treasuries, um, and maybe either like on par with traditional equities, but without the downside risk, right? And so I'm not saying someone should like not invest in stocks and only invest in like stablecoin yield, for example, right? But it's this idea that you can invest without the downward volatility of crypto, of equities, of anything. And where this really comes into play is in volatile market conditions, or in areas where maybe you think, if you're bearish on the overall market, overall in the market being that, like, if you think that something very bad is going to happen, right? Like if we've been in a bull market for a very long time, like overall, not considering crypto, but just like everything. I think that the money printer's been going crazy, right? Like the real rate of inflation is much higher than we think it is, or that's reported to us. And so we have to figure out ways to hedge against this. A USD stablecoin vault isn't going to hedge against the inflation, for example, but absolutely it'll hedge against these like downward markets, right? So like if the stock market crashes for any reason, or if we go into a recession, you're preserving your US dollars, and you're growing it at a reasonable rate that exceeds US Treasuries, probably somewhere between, you can get like 5 to 13%. Usually 11 to 13% is a spike. I think more of like 8 to 11% is probably the optimized range for like stablecoin yield, while still remaining relatively or low risk. Once you start to exceed that on like a consistent basis, the yield is either boosted, it's unsustainable, right? Or it's usually in those, or it's a scam, right? Which is like the worst case scenario. Boosted is okay because it'll just run out and you can just kind of like milk it in that time. But most of the time, these sort of juiced yields are unsustainable. They come back down, people move their money, right? Because these rates are derived from borrow demand on chain. But yeah, so basically I built, to make it to be more succinct, I built Pistachio as a way to make it super easy to get your money on chain, to grow your money on chain without needing to have volatility risk, without needing even to have gas, right? Like you don't need a lot of big thing about Ethereum is in order to send money, in order to deposit money, in order to do anything on chain, technically you need gas, and our whole app is gasless. You can deposit, you can withdraw, you can send money to someone in the sense that, Americans are very familiar with Venmo. We've done it in a way where you can transfer money to anyone in 130 different countries, like an unlimited amount, essentially, because it's all on chain, without gas, right? And it settles within less than generally a second if it's on any of the L2s. And so it's just, for me, I'm trying to fulfill the future vision that I saw for like the automation of like a cross-border finance, of a more permissionless finance, right? Where you can just kind of have access, like anyone in the world can access these things, and be able to send money permissionlessly across borders to whoever they want, right? And so in a more automated fashion. And so that's what, it's really cool to kind of like be here 9 years later after remembering me reading this book, being inspired of like the automation of finance.
And I forget who said this, but it was one of the takeaways that I saw from DevConnect, is that they were having a lot of conversations, and a lot of the people there weren't necessarily like meme coin, shitcoin traders. They were just like normal people who have stable coins, and not even a stable coin in a vault or in Aave or in anything. They're just holding ETH dormant. They're just holding their stable coins dormant. And so I'm wondering if you had a booth at DevConnect, and so I'm wondering if this experience resonates with the one that you had on the ground. Were the conversations you were having with people the types of folks who were just like holding ETH without staking it, holding ETH without putting it in vaults, holding stable coins without putting it in vaults? And do you think that like you're going to be able to sell them on being able to deploy their capital in something like this, Pistachio?
Yeah, I think that's the $1 million question, right? I didn't run into as many of those conversations, to be honest, of people just holding, but I can empathize with the reason. And it's just, that's the lowest risk, right? Just by holding just vanilla stable coins, by holding vanilla ETH, especially if it's on like the L1, for example, you're minimizing your risk. You're taking, there's risk, there's additional risk in L2s, there's additional risk in DeFi, there's smart contract risk. There's a reason that the yields are higher, right? Like everything comes down to RR at the end of the day. If you want a higher return, you need to take on some higher risk. But the most intelligent way to do it is to just take on intelligent risk, right? Like understand the risk that you're taking on, and then understanding if the the reward is worth it. And so I do think to some degree I'll be able to get these to sort of people in. There's a reason that there's like billions of dollars locked in DeFi, right? Especially like institutional grade investors are deploying their money on chain to these types of vaults. And so it's about bringing access to those institutional grade vaults to retail, right? It's like giving Alice and Bob the same sort of access to yield opportunities that these hedge funds are deploying their money to, right? And that's, I think, something beautiful about crypto that's not really available in traditional finance.
Yeah. I want to jump in real quick and talk about risk. And I think that there's two lines that I want to go down as we pull this thread. And one is going to be risk for your crypto native, your on-chain degen. And then the other one is going to be for someone listening to this who doesn't have stablecoins, doesn't have ETH yet, but they're getting interested in allocating a portion of their capital into on-chain features. So the first type of risk I want to talk about is for someone who's never been on chain. And when they hear like Pistachio creates an account in a way that's unable to be hacked, that is just kind of like, I don't want to say, it's something that their ears perk and they're like, what the hell does that mean? So maybe to like walk down that line, I think the happy medium for how we can shape this discussion is, why did Pistachio opt to use MPC as part of the way to create accounts? And what does that mean for you, like legally speaking, that removes concerns that Pistachio has to face from like the SEC as being a broker-dealer or anything like this? How are the ways that accounts are created, they're safe, and that Pistachio can help somebody get access to their account if they lose like their cell phone, but at the same time not be beholden to Pistachio and worried that you guys are going to get hacked and our information is going to be leaked, a la all these major leaks that we've seen over the past 10 years?
Yeah, great question. And because there's a lot of thought went into the architectural design of this in order to satisfy everything that you just talked about, right? And so where to start is that most people, the perspective that we took was, okay, there's all these existing attack vectors. How can we just like systematically eliminate each one? And that came down to, it's like, okay, hacking, phishing, and draining are like the three biggest ways that you can be hacked, essentially, right? That's one is someone gets a hold of your seed phrase. Two, that's like the hack. The phish is that someone gets a hold of your a password when you sign in of some sort, right? And they're able to like to access your account. And then the drain is that you sign something malicious because you're not screening the transaction, and basically it's a contract that just it has the ability to automate the way to take all of the money out of your wallet, right? And all of these are very bad user experiences. The worst user, Vitalik says the worst user experience is negative 100%, right? It's like volatility you can stomach because maybe it comes back up, but if you lose all your money, it's gone. Like you really can't get it back. And so we made it in a way where we save the private key of your wallet, right? Of your access key, your private key, the thing that you use to sign transactions, to the hardware enclave of your phone. So we don't have that, right? Like that is locally on your device. And this does a few things. One, we made it so that in order to get into the device, you basically need a biometric or a PIN just to like access the device, which is become pretty standard along or among fintech devices or fintech apps. And then the second is that in order to sign a transaction, in order to like move money at all, right? Because that takes first you need to have your device. We multi-layered that with the multi-factor authentication as well of, again, the biometric, or if you don't like biometric, a PIN. Biometric being Face ID or fingerprint for Android, which most people are comfortable with. If you're not comfortable with it, we totally understand. You can just do a PIN that you have to like memorize, and that's like the risk, right? Is that, remember your PIN in order to be able to like have that send. And so this creates like a level of security where if you're not you can't send the money you can't access the money, you can't send the money out, you can't move the money, you can't do anything, right? If you're not you, which is great. And then the question becomes, well, what happens if I lose my phone, right? Because the key is stored locally, and the full key is stored nowhere else. What happens if I lose my phone? What happens if my phone is stolen, right? Like if the phone is stolen, you wouldn't have to worry about anyone actually cracking into it. They can't extract the seed because it's within the hardware enclave of your phone. They wouldn't be able to access the app, and they wouldn't be able to sign anything, right? So like there's no real worry about your money being gone, but it's like, how do you get access to your money again? And that question, I think, was really important for us because while trying to onboard a lot of people over the last decade, I've seen people, like one of my friends was finally like, yeah, fine, I'll download it. I try to get him onto MetaMask, however many, 5 years ago, maybe at this point, maybe 4 years ago. And he got to the point of the seed phrase and just closed the app. He's like, nah, I'll do this tomorrow. I'll do this later, and I'm like, oh, that's a big conversion fall off, right? Like how many people, one, don't do it because of laziness of not wanting to write down 12 words. And then two, just also the fear of like, hey, if you lose these 12 words, you just lose access to all your money. It's like, that's not great. That's not like a fun thing to have to like internalize and like, okay, so what if there's a fire? Okay, so I have to write it on something fireproof, and then I have to duplicate it and put it into the bank and then put it here and then put it here and all these different things, right? And so you mentioned MPC before. So MPC stands for multi-party computation. Basically multiple parties are needed in order to do some sort of like cryptographic proof. And what we've done is we've enabled MPC specifically for recovery. And what this means is that when we save your private key to the hardware enclave of your phone, we also are creating a backup for you. But this backup isn't one full key. It's actually two different key shares. And so with the two different key shares, they're both encrypted. Half of it, so both of these are two halves of a key. One half is stored on your cloud, and the other half is stored on Pistachio servers. And what this means is that if both our servers in your cloud are also both encrypted. If that encryption is broken, which is less likely, it's more likely that there's an internal hack somewhere, either to our servers or to your cloud, right? Your password is compromised. It's why we don't use passwords. We use one-time passwords for everything as a liveliness check to prevent that phishing attack vector. And then so let's say they get access to this half the key. They can't. Again, it's encrypted, right? They get access to your cloud. The key's encrypted. The key half is encrypted. If they do somehow break it, which is unlikely, then they only have a half and it's entirely useless, right? So even more unlikely is them getting access to both of these halves. And even if they somehow do, you actually can't put them together. If you have both halves, the only way for these halves essentially to have the glue to be able to like be put together is if the user themselves initiates the recovery via a liveliness check of a one-time password, which you basically via your email or SMS. And also, again, with the biometric that you set up originally. So how this works in practice is that when you create a Pistachio account, you sign up with your email, you get a one-time password, you choose a username, we create your key and you're in. So it's I think onboarding takes about 45 seconds overall. So it's a fairly quick process. You now lose your phone, right? Or your phone's stolen. Like, that sucks. But at least they don't have access to your money. So what you do is you go get a new phone, right? So I go get a new phone. I go get a new iPhone. I sign in. I now have my I sign into I have my iCloud because I'm recovering all my data, all my apps. I have my Gmail, right? I sign into I download Pistachio. I sign in with my Gmail account. It sends me a one-time password. I get it, right? It as a liveliness check to show that I'm me. Of course, all my biometrics are already stored within Apple being secure, so I don't really have to worry about any of that. It checks that it's me because of the one-time password and the biometric, and now I'm in, right? And that's it. Basically, Pistachio servers say, hey, you have a new phone. You approved, you passed the liveliness check, and you passed Apple's or Android's biometric check. We can release this other half of the key because you have your other half of the key and have shown that you're you, right? And so in practice, it's recovering your key is just as easy as like account creation. You're just signing in on a different phone, because if you're not you, you wouldn't be able to sign in on a different phone. Someone actually tried to break this in a way to like as like a gotcha moment for us. He's like, my friend was able to sign into my account on his phone, and it was because he gave him the one-time password, right? And so, but the guy wasn't able to sign for anything. He wasn't able to move. I'm like, okay, try to move the money. And it did, like the guy had access to like see the account, but he couldn't move anything because he didn't have the key. He like was able to sign in as sort of like a read-only thing, but he didn't have the key to do access, right? He didn't have the half of the key. He didn't have like the biometric access. And so this was actually, I think, before we even had the biometric access for everything. So now this guy wouldn't even be able to do this sort of like read-only thing. This was over a year ago at this point. So that he wouldn't even be able to do this sort of thing that, again, didn't even work.
Yeah. Cool. We have a little bit less than 10 minutes, and there's still 3 things that I want to get through.
Got to be succinct.
Yeah, and this is really like these 3 things are like the killer reasons why you should be using Pistachio.
Mm-hmm.
So first of all, when you go on now, there's 3 different vaults that you can choose from. 4 different vaults, excuse me, to gain yield on either your USDC, your wrapped ETH, or your CBBTC. So what are the pools and the vaults that people can contribute their funds to? And how do you guys choose which pools and vaults to implement into Pistachio?
Great questions. So in its current iteration, we have 4 vaults, right? In the upcoming iteration, which hopefully should be live sometime in January, and so this will be very timely, we're basically changing up our user experience, our UI, and this will allow users to choose the asset that they want to earn yield on. And this will either be dollars, euros, ETH, Bitcoin, and then eventually even like the Mexican peso, the Brazilian real, and gold, right? And so like we're coming up into like real world asset territory here. And what it does is we're making it more, I want to improve the trust, basically. I want users to come in and be able to see, okay, these vaults are legit. This is like the risk profile. So we're actually integrating risk rating into everything that we don't do. It's actually like an external party who's very professional called Exponential Fi that does, institutional grade risk rating essentially. And so we're just going to leverage their grades for all these vaults. And putting them in so that users can earn on whichever of the asset that you want to earn on, right? So this does mean we're going to be integrating more vault players. And so how do we choose who we integrate? And so it's basically the process is going through and finding out a lot of it's like reputational to start, just like figure out what direction I want to go in. We don't use a lot of players who are too new just because they need like more time in the market to kind of improve their standing, make sure they're hardened and not hacked and those sort of things. And then it's like you can tell by either like TVL, but also like their risk framework. And I just basically go back and forth with their BDs quite a lot to understand how they observe risk. And what that means is like what are their underlying assets and how intermingled are they with other vaults and what are the risks, right? And so For example, we're going to be integrating one vault provider called Gauntlet. Gauntlet is probably known as one of the top 2 risk curators in the entire space. They have different vaults for different risk profiles, right? They have like some safer vaults. They have some that are a little higher up on the risk curve, but overall their risk framework is very good, right? Like there's been a few hacks over the last few months that people have lost a lot of money to, especially when it comes to like yield bearing stable coins, right? Like XUSD and Stream. And things of that nature, right? It's like, okay, like where does the yield come from? And Gauntlet, for example, had absolutely no exposure to any of this because they said that XUSD did not comply with their risk framework, right? They took one look at it and they were like, absolutely not. It's a black box. Basically, if things are a black box, if your strategies and your funds are off chain at all, you're eliminated from a lot of these risk profiles. And that's where trust comes into play. That's where the blockchain shines, right? Is like, okay, if your strategies, if your volume or TVL, right? If your liquidity is all on chain and we can see in which vaults that you're holding the assets, okay, we can determine the underlying risk of each vault, which rolls up into the overall risk of the curated strategy, right? And so that's kind of like a big thing, is making sure that these curators do have this and that they aren't exposed to like high risk interest bearing stable coins. Like, for example, some of the other risk curators like MEV and RE7 had exposure to XUSD, right? Via like their underlying pools. And so this then becomes a question of, okay, well, how is their overall risk framework working? If they were investing into these sort of things at a minimum basis, what does that mean for their other pools, right? And so I sort of look at it as, I tried to be very cautious with who we want to integrate. There's another provider called Yo who does something very similar, high quality risk framework. And they have a lot of what these guys do is they try to make redemptions as instant as possible. And they also use a company called Hypernative. So Hypernative is used by Gauntlet, and Yo Vaults are currently integrating them. So they're not live, but they will have it. And it's basically just like on-chain threat monitoring. And what this allows these vaults to do is that they're able to see if an attack or a hack is being triggered or if something's happening, right? If something's amiss, and create automations from that to where like Gauntlet can essentially pull their money out because they're constantly watching these vaults. If anything is triggered, it triggers an automation for them to pull the money out, right? And so that's just like another layer of like risk mitigation of, God forbid someone is trying to hack one of these vaults, that a hack does somehow happen, that their money is the first out, right? And that which is essentially your money, right? And so it's just another layer of security. And so what we do for these vaults, for everything that we do, is we are now giving them risk grades. We're showing you the historical APYs. We're showing you if are they protected by Hypernative or not. We'll then show you like the further risk breakdowns. What are the underlying pools that are in there? And some of this may be too much information for someone who's not familiar with on-chain, but like on-chain investing. But I would rather at least like give you this information in a digestible way that you can see it and do your further due diligence if you want, right? Like, actually, it's funny, when I was originally selling life insurance back in my first like financial advisor job, we would sell life insurance as an investment vehicle in which you could wrap around like variable insurance. It's called variable insurance, but basically it's insurance you could wrap around the stock market and equities, right? And you would have control over your investments. And the big competitor to that is something called whole life, which is essentially a black box. It's like, we're just going to give you 5%. That's it. We just give you 5%. You don't know what's invested in it. You don't know what's going on. You don't know what the fees are. You know nothing, but we just give you 5% and you're happy. And so like, I like don't agree with that sort of perspective of like investing. Like, I want to know what my things are invested in. I want to know what the risk profiles are. I want to know what the underlying pools are. And so we try to be very transparent with all of these things. And we try to only integrate, well, we only integrate players, not that we try, we only integrate players where we can get this information and display it to the user so that you are at least equipped with knowledge, if you so choose to, if you want to be equipped with the transparency to be able to see where your stuff's invested in, so that we can improve the trust within the user relationship, right? Like, you need to trust Pistachio, you need to trust these vaults. You are taking on like a higher risk by investing in them. So like, it's up to me to essentially give you equip you with the information to be able to make this decision as a user if you want to invest or not.
Awesome. Well, we have hit the top of our hour. I think for anyone who's listened to this, after hearing all of everything that Brian just kind of like laid out, there are two kind of killer features that are going to be added to the app soon. One of which is called Pods, and the other is called Card. Pods will basically create an AI-enabled automatic rebalancing system for portfolios. And Card is actually going to give you a bank account in Mexico, Brazil, the US, and the EU. So maybe we can have a space in the future to kind of like dig in further into these once they're live. But I think that these are, if you've heard everything that Brian said, you can really understand and appreciate the value of trusting the services that are implemented into the app, and that you as the user kind of have ultimate control over the assets that are underlying. So keep an ear to the ground for these forthcoming features that are going to be added into the app. So I guess kind of like my final question then for you, Brian, is who do you want to reach out to you? Who do you want to beta test the app? And what's the best way that they can get in contact with you and Pistachio?
I think if what I said calls your attention, right, then absolutely you should try the app at minimum. We're always doing a lot of beta testing, a lot of bug fixes, and so anyone who's willing to come in and try to break it, will log those and try to fix them as fast as possible. Dylan himself found like 8, maybe more bugs, and so all of them are now fixed, and we thank him very much for breaking it. The easiest ways to get in touch with me, I'd say, are the easiest ways probably at this point X. So my tag is at bsmokes, BSMOKES _. I would say Telegram, but I just recently enabled the spam filter so that unless you're already friends with me or you're a premium member, you can't message me. I just get too many spam messages, which are just annoying at this point, and so I just decided to cut that loose. So yeah, connect with me on X, reply to me, or send me. I think my DMs are open there, so just either send me a DM. If I don't reply to me, and I'll eventually I'll see you. Like it's easy enough.
Yes, you're a prolific poster and responder. Very much appreciated from a founder.
Yeah, ultimate reply guy.
Yeah, man. Well, this was awesome. I was looking forward to having you come on the pod since we met at ETH Mexico. And honestly, we probably didn't get to cover half of what I wanted to cover, but that just leaves an opportunity for the future to create more content together. So, Brian, with all that said, thank you so much for coming to join the Smart Economy podcast today. If you haven't already been pistachio pilled, go check out the app. I myself am a crypto boomer. I'm a desktop first type of user. And this is kind of like the first mobile app that has like invigorated my love for what they can be. So thank you for building that and for building Pistachio. You've brought me from the depths of crypto boomerism. And yeah, man, great to connect at the events we've connected. Very much looking forward to future connections, IRL and online. And thank you for your time today.
Yeah, my pleasure, man. Thank you so much for having me. I really appreciate it. It was a fun time.
Cool, man. Cheers.
Cheers.
Thank you so much for tuning in to the Smart Economy podcast. To stay in the loop with all of our latest episodes and insights, head over to www.smarteconomypodcast.com. And don't forget to subscribe to our YouTube channel for all of our video content. If you enjoyed today's discussion, please consider showing your support by liking, commenting, and reviewing this episode on your favorite podcasting platform. Your feedback helps us reach more listeners and bring even better content your way. And we'd also love to hear from you. So please drop a comment on Spotify or YouTube to share what topics you'd like us to cover next or who you'd like to see as a guest on the show. And if you or someone you know might make for a great guest, please don't hesitate to reach out. We're always on the hunt for fresh voices and new perspectives. And for our NEO token holders out there, please consider voting for NEO News Today as your council representative. We've proudly been serving the NEO ecosystem since 2017, and we'll continue to do so by putting portions of our council rewards directly back into ecosystem growth initiatives. So, one more time, thank you so much for listening to the Smart Economy podcast, and we look forward to catching you next time.